Lately, I've been noticing an increase in the number of headlines that have this general sort of theme. This notion that we might be in a commodities supercycle. And for those who are unfamiliar with the term, a commodities supercycle simply refers to the notion that we might be in a bull market for commodities that lasts more than a decade. Now, traditionally, I would look at this sort of hyperbole and simply discard it, because generally it is the nonsense that financial journalists come up with that really has no basis in fact. This one is slightly different in that when we look at commodities, particularly over the past year, we can actually see an emerging bull market. And what I want to talk about very briefly is the appearance of this market, its segmentation, and perhaps how people can take some form of advantage of it. So if we have a quick look through each of the commodity groups, you can actually see that many of them have been in extended bull markets. These are grains, for example, and you can see that there's been some quite remarkable moves, particularly in canola and corn. The exception here is, of course, rough rice, which has spent most of its time going sideways. The picture is a little bit more complicated when we look at the softs, because there is not that widespread uptake. And this is one of the things I want to talk about, is the notion that a commodities market, whilst it is referred to as this singular homogeneous mass, is actually quite a diverse ecology. Commodities are very, very, very different. And you can see that here. You can see that cocoa, coffee, orange juice have really been quite ordinary, whereas cotton, sugar, and in particular lumber of recent times have had quite substantial moves. The same mixed pattern appears in sort of the energy complex. You can see crude, ethanol, gas oil, heating oil, gasoline, and West Texas intermediate crude have all been positive, but natural gas has been in a sustained bear market now for several years. What is interesting about commodities and talk about commodities is that the moment you mention the word commodities, people automatically think of gold. And despite what the people who flood my LinkedIn profile say, gold is not the be-all and end-all. And what we can see here is, yes, gold had a reasonable 2019 to 2020, but since then has been a very, very poor performer. And in the past year, as we'll see in a moment, it has been outperformed by virtually every other commodity, including cheese. A similar picture emerges for the industrial or base metals, virtually all of which have been really quite outstanding for the past year, perhaps 18 months. But one of the things I note when I listen to financial commentators talk about a commodity supercycle is they generally reference an index of some sort. More often than not, they will reference the CRB index and say, look, it's going up, all commodities must be marvellous. Unfortunately, as we've just seen, that's not true. Commodities are a mixed bag. They're not all the same. And when you look at something like the CRB, you actually have to be acutely aware of the way it is structured. The CRB index itself consists of 19 commodities, and it's a weighted index. Energy makes up 39%, agricultural commodities 41%, precious metals 7%, industrial or base metals 13%. The easiest way to think of this is to perhaps think of it in terms of the ASX 100. If you took the top 20 shares from the ASX 100 and had them go up, the ASX 100 index would be going up. The problem is when you make a widespread generalisation and say the index is going up, you have to be aware of what the drivers of the index are. In this example, it would only be the top 20. That would mean that 80% of the index is not going up. And so any sort of broad judgment you make, any blanket statement, has to really be aware of or take into account that indices don't tell people the story they think they do. And I'll give you an example of that in a moment. And you can see this when you look at the breakdown of the individual sectors into their particular indices. You can see, for example, in this case, that precious metals have been quite ordinary when compared particularly to agriculture and industrial metals. So again, we see this segmentation, this breakdown of commodities into their different groups. And so simply saying all commodities are going up is a nonsense statement. And it's a nonsense statement because the problem it engenders in traders is that they think that, well, if I buy a commodity that hasn't gone up, it will naturally go up. No, it won't, because commodities are not like the components of an index. What happens in an index is that you get very much a treasure hunt. So what happens is that you'll have people buy into a given segment of an index. They will then perceive using their models that that part of the index is now fully or overvalued. They have cash to spend. They will look around for something that is similar or analogous. They will apply their valuation models, generally come to the conclusion that something is undervalued, and then buy it. And so you get this flood of interest moving through an index, generally from the top down. That doesn't happen in commodities. Commodities are not equities. And unfortunately, many people speak of them in similar terms to equities, and they make the same assumptions, and those assumptions are incorrect. But if we come back to the breakdown of commodities, how they have performed over the past 52 weeks, this is just a quick and dirty little chart on how they have done. And you can see the standout performer is lumber. And intriguingly, over the past 52 weeks, lumber has outperformed Bitcoin. You can see I've highlighted in purple gold. And you can see almost everything to the left outperforms gold. As I said, including cheese and milk. It's interesting that there are only two poor performers, and they are butter and orange juice, very, very old-fashioned commodities, very traditional commodities. However, knowing that commodities are going up in a broad sense doesn't in any way really help us. We actually need a mechanism to work out how we can take advantage of this. And I'm going to start from the presumption that not everybody wants to trade commodities on a commodities exchange. Some people are uncomfortable and unfamiliar with them. And some commodities have tremendously unfriendly dealing hours. Commodities such as live cattle are open for short sessions in the middle of our night. And so they're quite difficult to trade. And so what traders often do is look for analogues or vehicles that have exposure. But that's often quite difficult to do because there's a paucity of information regarding what companies have exposure to what sector. I will preface this by saying that if you have some form of logical trend following scan, then these companies should already be appearing. You might not know what they do, but in some way, shape or form, they should be appearing in the results your scan throws up during the week or at the end of the week. But there are a few mechanisms we can use to try and build a list or a ready reckoner of what stocks have exposure to what commodities. This is just an example of one. This is the site marketindex.com.au. If you go to this site, you'll see along the top menu a series of submenus. You've got home, ASX indices, commodities, popular pages, plans and portfolios. If you click on the commodities page, it will open in a drop-down list that gives you the names of several different commodities. And in this one, I've just clicked on crude oil. What you'll see is a range of statistics pertaining to crude oil, a little bit of a price chart. But if you scroll down to the bottom of the page, you'll find this. And this is a list of ASX companies that have exposure to oil. And what I've done is I simply ordered this in the greatest return for the past year. That's why things like Blue Energy are at the top. And you can do this for a raft of commodities, and it will throw up a raft of stocks that you can potentially gain exposure to these various commodities through. Now, I mentioned that this notion of accepting a blanket judgment over a group or an index does have some problems. And this is the example I want to mention. For example, over the past year, the All Ordinaries Index is up 34.41%. The judgment we take from that is that I have a stock in the All Ordinaries, therefore my stock must go up. Well, that's not quite how it works. Because if we break down the returns from stocks in the All Ordinaries and we have a look at them, we see something interesting. We see that whilst the index itself has gone up 34%, 17% of the component stocks over the past year have a negative return. So there's almost a 1 in 5 chance that the stock you own has delivered a negative return. And this highlights the difficulty of these broad judgments and then using that broad judgment to make a decision that lacks fidelity or that does not in some way, shape or form reflect what's actually happening with the instrument, tool, share you're actually buying. And to give you an example of the extreme ranges you can see, within the All Ordinaries for the last year, we see that VUL or Vulcan has had to date a return of 3,400%. But EOF has had a return of minus 70.39%. And all other stocks fill in the spectrum of returns in between this. Just because you have bought a stock in an index does not mean it is guaranteed to go up when the index is going up. Likewise, just because you have bought a commodity during what is perceived to be a commodities supercycle does not actually mean the commodity you have bought will go up. So this brings us back to sort of the initial question that was posed by that piece I snipped out of Forbes magazine. Are we in a commodities supercycle? Well, the answer is I don't know. And the answer is nor does anybody else. What we do know is that several commodities have been extraordinarily bullish and have offered traders excellent opportunities to be profitable. But in terms of it being a super cycle, we won't actually know until the cycle ends. And the final point I'll make about commodities is that whilst many have shown extraordinary gains and traders have done very, very well out of them, we come back to that point that commodities are not equities. Equities are unbounded. And by that I mean you will get an equity like Vulcan that produces a 3,400% return. You won't see that sort of return in commodities because they are bounded by a variety of factors, but most tellingly, the laws of supply and demand. When they become too expensive, those people who require them for whatever industrial or agricultural process they undertake will simply stop buying them. And so whilst you do get rampant speculation in commodities markets, and it is that speculation we're after, it does not in some ways mirror the speculation we get in equities markets, which is often why you will see when gold is running, that gold shares do better than the actual underlying contract. It is because they have that unbounded speculative fervour. So what does this mean to traders? Well, in the grand scheme of things, I think not a lot. And I think not a lot because if you're a systematic trader, as you should be, then you're actually guided by the rules of the system. And the system will inform you as to when a trade has come to an end. But we come back to that age-old problem of it is extremely difficult for traders to hold on to winning positions without wanting to cash them in early. And that is a fear and a difficulty that all traders actually have to work for. And particularly, you have to work through it when we're in the midst of extreme bull markets like we have at present in commodities.